Hello, everybody. Today is Wednesday, August the 19th, and I am John Blank, the Chief Equity Strategist and Economist at Zacks Investment Research. The point of this discussion will be to provide to all of you a guide to the top 2026 ETFs and more generally to ETFs. So I will go through the broad ETF narrative, get you up to speed on how the ETF marketplace has been constructed and has moved forward. Part two will be the very fascinating speculative leaders of the ETF space in 2026. It has been a very speculative year. And part three will be how to manage your portfolio returns using these ETFs. So keep in mind, these are my views. I do have a PhD from MIT, and they are not the views of Zacks Investment Research. So we will begin, like I said, with a broad ETF narrative. And I want to show you a timeline going back from the 1990s through the 2000s, through the 2010s, and of course now into this 2020s, where we have this story. And then if you go out even future, all the way out to 2020, 35, you can see what's going to happen here at people's minds. The active ETFs are going to grow more and more. Passive ETFs, where the fixed tickers are in the ETFs, they do not change, is going to keep being a big player. And then you've got active mutual funds, which are going to be disintermediated and down, while passive mutual funds might actually expand their interest. So keep this in mind. This is just someone's view, not the view. But the other thing to understand here is back in the 93 period, SPY from the State Street was the original one. That was the S&P 500. It was all the way back in 1993. And then we moved into bond ETFs in 1995 and so on and so forth. The market broadened in 2000. We had gold ETFs, actively managed ETFs, currency ETFs, convertible bond ETFs. So it really started with stocks and then moved into all kinds of different spaces. And now we're into this global mainstream of all this different stuff, not just in the US. And then now we've moved into even more expansion with spot Bitcoin and digital participation and things like this. So it is a really hot space. There's no doubt about it. And keep in mind here, there are core definitions and characteristics of ETFs and what makes them attractive. So what makes them attractive, of course, you can diversify away from one stock to many stocks. They're lower cost than a lot of mutual funds. They're easy to trade because they're exchange traded funds. They're traded on an exchange and they're transparent. You know what you buy, you know what you hold. That's the main key difference here between mutual funds and ETFs is you actually can keep on track of what you bought and what you hold. So the rest of this you can read at your leisure. I will provide these slides to those of you that contact the company. And in this particular case, there will be a lot of information for you to look through. All right. So as I said, there are now, after 30 years of this, immense number of different types of ETFs. So there's buy and hold, diversification, sectors, market timing, hedging, leverage strategy. That's now big in this space, and we'll see that today. Income generation, of course, dividends. Global diversification gets quoted foreign markets. Inflation protection, yeah, you can do that. Value and growth, thematic investing, arbitrage, pairs trading, two related ETFs, and tactical asset allocation, equity, bond, and commodity ETFs. So there's just an enormous array of tactics and strategies that are involved in this space now. It's no longer like all of you think. To begin with, the 1993 SPY. Although, frankly, the SPY is a fantastic ETF and it has held its ground all these many years. That gets us into this story. Here's all the different definitions in net asset value, premiums, discounts. The story of how these things get valued is worth reading. I won't spend a lot of time here, but it's worth understanding how this works. And it's worth understanding the big players. There's 10 big players here. And as you can see, half the market, 60% of the market is BlackRock and Vanguard. Add in State Street and you get to close to 73% of the market. So three big players. I can get to 78% of the market with Invesco. I can get to pretty much everything with the rest of these names. So this is a very institutional space. I will point out that the Vanguard ones are just so much cheaper than everywhere else. If you want to hold stocks in an ETF, we got to thank John Bogle at Vanguard years ago for keeping them cheap, and I frankly haven't seen anything benefit investors such that this expense ratio does not matter. The other good one, of course, is Charles Schwab. They do a pretty good job of keeping expenses down as well. Some are very poor here. First Trust. This is, one of these high beta or alpha companies, and they will charge you for that service. So will Invesco. But keep this in mind. Here's a nice little chart to look at the different strategies of these different institutions and how pricing works. All right, so here from the SEC and FINRA, who regulate this stuff, is the discussion of these types of instruments and how they are created. It's worth understanding these from the perspective of how they get created, because, of course, now we have creativity galore in this space. So come back to this chart at your leisure and look through the regulators' views of how these securities get created. All right, so this will give us a comparison of ETFs versus stocks versus mutual funds and the amount of interest that you might have in understanding how they play out. Again, this is coming from the SEC, and it is interesting and to understand from the regulator how this actually works. But for our purposes today, I'm going to move on to the top 26 ETFs, take a deep dive, and show you what I've learned. So first of all, we're going to have two tables today. We're going to have a type 1 table. We're organized into 7 different groups, as you can see those groups here. Type 2 table, we're going to have a little broader collection. We're going to have geography, single country, style, sector, metals. We're going to have a lot different story here. And this is going to be a much more traditional asset allocation approach. So keep that in mind. All right, number 1, I want to talk about this first table. This is asset class table 1, like I talked about. So here's your balance, commodities, currency, equity, fixed income, and alternatives running across this top. Here is the 2026 story. Down here, you can compare that with the 2025 story or even further back, the 22 to 24 story. So I want to point out something here, though, that this top return stuff, I'll pick off this guy, this guy, this guy, this guy, this guy, and this guy. And you're going to see that immense amount of speculation here. So return stacked ETFs, that basically means leveraged. So this RSSY is a leveraged stock and futures one. Breakaway shipping has just been crazy because of this Strait of Hormuz thing. Galaxy hedged digital assets, that's crypto, but it's hedged. Granite shares 2x Dell. A lot of these single stock ETFs are getting crazy. Look, there's MUU, there's Intel. You can see Marvell. These are all these single stock leverage ETFs that are hitting the charts at the top. And then Highland Opportunities closed end funds for bank loans. This is where you actually buy bank loans. Again, very speculative. You don't know the bank's story. And enhanced options indexes for oil. So as we talked about, if you want to play this game here in 2026, it is speculative across all of these asset classes. Frankly, interesting to know that. Now let's look at this other breakdown, what's also been working here for 2026. Again, I'm picking off these top guys and explaining them to you, but you've got the 2025 and 22 to 4 stories. So what's going on? Wheat doing extremely well. Emerging markets, high yield bonds doing well. iShares Asia 50, AIA, interesting. A currency shares Australian dollar trust in currencies is actually doing well. Copper is doing well. Of course, the semis in the sector space, the South Korea story, of course, we all know this, that it led the way for a while, and I'm sure that's tied to the Asia 50 story and Taiwan. And then down here, something really worth knowing about the VLUE, the iShares Morgan Stanley Value Factor ETF. So even maybe the only one that is not speculative is down there at number 8. Fascinating stuff. Like I said, you're going to need to get these tables from us so you can understand this better at your leisure. All right, so let's get some data points on the table here. There's the Invesco Semiconductor ETF, that's PSI. We get the Global XAI Semiconductor Quantum ETF, that's CHPX. We get that First Trust Bloomberg Emerging Market Democracies. This is a very small fund, but there's such a thing as these ESG funds. And down here, I've got the Global X Lithium Battery Tech thing. That's a decent sized fund. So a lot of people are playing the semis and these lithium batteries stories now. That is the story of 2026, playing these games with these novelties. So what do we get out of this? Up here, we've got the semis and the AI numbers. Of course, these are high price to book values, and they're capital light, and they've got massive growth expectations and monopoly power behind them. That is pushing this up. Lately, of course, it's either a bubble or not. But down here, the lower price to book ones have asset heavy operations. These are mining operations, and they have commodity cycle headwinds. So the battery tech and the ESG ones have, you can see here price to books 3 and 4. Versus up here, you've got 10, 13, 14, 15. Very different stories of what you're buying here. ESG and lithium battery techs are bottom row, and they're lower price to book, and the top row is the semis and the AI names. So this is the story of this very momentum traded speculative market, like I pointed out. All right, so final one I want to talk about is how you can organize portfolios in a number of ways with all these ETFs and see if you can enhance returns in a portfolio context with ETFs. So what I did is I've got 6 different strategies, and I walked through with AI how you can play them and work out with them. So let's take a look. Number 1, we've got this story of the energy, small cap, biotech, and emerging market funds. These are the names of all these groups. One of them is iShares E&P, of course, Clean Energy, PSCE, and small cap energy. So in general, it was the oil and gas standard players that led the way here. And that has been a really interesting thing. So what we learned here is asset selection and macro exposure played a much more important role in total return. So you had this idea that really playing around in the niches here did not serve you well. Staying at a high level with the major institutional stuff like IEO right here built this returns for you, and that was playing out all the way across the space. So first lesson, there was a lot of dispersion in this marketplace, and it didn't pay to chasing the scary stuff, the interesting stuff overall, and when you could have just bought the big oil names. So let's take a look at this one. Now here we get tech and semis in here, and you've got a whole different story here. I threw in Chile and Brazil, 2 country ETFs here. The rest of these are tech and ETFs. So this is a different break. And of course, incredible run by SMH. This is the semiconductor ETF, and that's 1,000% gain. You're not going to see these again, these types of numbers in a stock context. The semis were just crazy big. MSMH and SOXX are almost perfectly correlated. And again, you don't get a lot of value out of staying away from it. The basic point here is you wanted to stay with the hypergrowth thematic leaders this year. Whether that plays out in the future, who knows? But it just tells you a lot about what's been going on in this space this year. Number 3, tech-focused IGM is our leader here. Right here, tech-focused IGM with a 383 gain. However, we do have financials and insurance and IAK thrown in this one, and we've got property and casualty KBWP, and the energy giant XLE, which is here. So here we got a different set of focus, and this main player here is the tech-focused one. And what we learned is equal weighting in this environment actually played out better. That over-allocating away from top growth providers into lower beta international plays did not work out. Again, this has been a very speculative market this year. I don't know if this is a longer term story. I don't really think it is, because it just has not played well for diversification. And it's been an AI semiconductor and type environment. It's been very narrow, and there has been little value to this diversification story, which is what I kind of wanted to show you today. Number 4, commodity funds, gasoline funds, of course. The equity convertible bond funds have also done extremely well. And of course, then we've got the crypto stuff that did not work in this sector. So again, over-concentrating in high volatility assets, elevated risk, and it did not boost returns. This again is the story of 2026. I'm not telling you this longer term, but there really was not a lot of value other than playing these narrow themes in the space, as you know. And I think this is very late stage to the marketplace, and that's why I would point this out as not a longer term story, but the 2026 story that we're in. Number 5, gold is in here, diversified equities. Here's some interesting ones, ACV and ETG. So let's take a look over here. ACV is here and ETG is here. They had decent returns over the last 8 years. Keep this in mind. And at the opposite end is tech-focused HERZ, which actually did fairly poorly. So again, it proves out that wasn't a lot of gains here from shifting away from the equal weight, which was basically fine. So that's what we're learning here. Being fancy in the equity portfolio allocation contracts about ETFs did not buy you much. And frankly, you just had to play the right themes this year and put your portfolio rather on the right themes, and you outperformed. So once and final one, I want to point out that leveraged gold funds and things like inverse long-term treasury ETFs, throwing those in gives you negative correlations, but it didn't actually put out a better name than just high-ranking dividend and rate-head assets. So again, what we're also finding out of this one, because of the long-term treasury fund depreciation, a rising rate environment is the back end of the story here. This is the 6th one, and it includes these long-term treasury funds. And as you know, rates are rising, and this whole speculative story is coming to a head. So keep in mind, this is a 2026 story for ETFs, and I wanted to clarify, we've got these big, aggressive ETF strategies out there that were very leveraged, very speculative, and now we've finally finished up with the story of the rising rate environment that's likely to pop all this and change the story for 2027 dramatically. So I do think this is just a 2026 story and not more broadly. You should carry it forward from there. Thank you for attending. And if you want these slides, you can find them from us at Zacks, 866-794-6065, or send us an email at strategycall@zackspro.com. And also find this material and us on the web at www.zackspro.com. Once again, I'll put these out there. If you want these slides, this is very dense stuff, and it really does need your attention. For the tickers and the returns, 866-794-6065, or give us a call at strategycall@zackspro.com. Thanks much, everybody. I hope you enjoyed it.